This morning, we had two folks from the Federal Reserve give us more insights into why maybe things are just fine and we don't actually have to cut rates 3 times this year. See, last week when we had the Federal Reserve meeting, we got what was a really dovish statement from the Fed. Priced in 3 cuts. They removed the word solid from the jobs market. Mark's like, oh, this is going dovish. Then J. Powell walked that back, went pretty neutral. 3 cuts seems appropriate, but hey, things overall are strong. And the jobs market is below break even, but it's okay. We're not in a rush to cut, which is weird because it's like, wait, if we're below break even jobs, then why are we not cutting more rapidly? Well, maybe it's because J. Powell was forging consensus with the 2 people I'm about to give us insight on who don't actually think we need to be cutting at all. For jobs. Now, I think it's important to remember quickly, what is this break-even rate of employment? The break-even rate of employment is basically the number of jobs required to keep the unemployment rate stable. So if we're at 4.3%, over the last year, break-even may have been, call it 150,000, right? And as we get 150,000 jobs, the unemployment rate basically doesn't move. That was our average unemployment or jobs read since, most of the year or for most of the year. Now, people are expecting that break-even rate could be somewhere between 20 to 50,000, maybe break-even. The Economist actually goes as far as saying 0 based on potentially negative net migration into the country, which this is also where a lot of people talk about the H-1B visa issue, which I can give you sort of a quick take on my opinion on what this whole H-1B visa thing is. It's basically a tax on people coming into America, right? And this is very popular because a lot of existing people already in America say, hey, we want more jobs for Americans. And so that's how Donald Trump and Lutnick are pitching this. They're saying, look, $100,000 H-1B application fee. So even just to apply, we're going to it's probably more like 20 to 40x the cost of the H-1B visa, which usually costs somewhere between $5,000 to $10,000. The gold card is an option to pay $1 million for residency if you're an individual, or $2 million per company employee if you want to relocate company employees in your business. So basically charge the businesses twice as much. But the business therefore is paying and they're maybe getting a tax deduction, right? So that's kind of how they're like reverse engineering some of these numbers. But anyway, the net effect of this is going to be lower immigration because companies that end up still hiring H-1B style people will not give them H-1Bs. Instead, they'll just say, go work at our Canada office. We'll buy, as an example, let's say you want to hire 100 Indian workers to work in, your technology department at Microsoft or whatever. Maybe you'll open a Vancouver office instead. The net result of that is lower migration into the United States. We're already having fewer, children below replacement rate. We already have virtually 0 migration, in part because of how stringent the border is now, which, a lot of people are like, that's what I voted for. Well, that's fine. I think Trump's done a great job on securing the border. I think some of the immigration raids are a little, excessive. And then obviously now this H-1B visa thing, all it's really going to do is tax more people coming here, which means fewer people come here. So that means the economies of other parts of the world benefit from more people, which means our break-even employment rate might actually be even lower. So in other words, to keep our unemployment rate low, if the employment population is shrinking, it's actually possible that you can have a negative break-even rate. Because if there are people, retiring or dying, and then fewer people are being born or coming into the labor force, you could actually be at a place where the break-even point for the labor report or the labor market job reports is negative. You could be at negative 20,000 jobs per month, and the unemployment rate stays stable, which was just like, that'd be crazy, but it's possible. And so that's what's driving people like what the Fed said today to say, hey, maybe the employment market is just fine. And so that's where we get into what Bostic and Muslim said this morning. So Bostic says, look, we're only going to pencil in one rate cut for the rest of the year. And this is something where, I've been telling people in the Alpha report, like, hey, like in the near term, we are going to be up against Treasury yields going up post-Fed. And that's exactly what's happened. We called that before it happened, which is important. Just looking at it in hindsight doesn't do as much good. But now we can look at it in hindsight. We see this bump right here slows down that movement in lending companies or real estate companies that really started rallying over this idea of lower rates. We're confident that this direction is continuing, but now the Fed's not only walking back market expectations that maybe we'll get 5 rate cuts by March. Now they're even walking back the idea that we'll get 3 rate cuts by the end of the year, with Bostic saying we're only going to get 1 rate cut by the end of the year. That will likely push gold higher. Stocks potentially keep slogging up, I like to say, and yields kind of stabilize, maybe somewhere around 4.15, maybe even 4.2. So it slows down the boom a little bit in terms of real estate related place, that is. Now, what really pisses me off, though, is you get people like Bostic who don't seem to really know where they want their jobs target to be. Bostic, for example, says the labor market is I don't believe the labor market is in crisis right now, but it's an open question in terms of how weak the labor market is. Well, shouldn't the Fed know? Shouldn't they have a standard? That's my opinion. That pisses me off a little bit. Like, I feel like they should say, we want this many jobs, and if we don't, we're going to cut. And just have some kind of clarity for markets to be able to expect something rather than, we'll wait and see. But that's what we're getting instead. Bostic says that the tariff impact has really been delayed, not just because of how Trump implemented them, but also because businesses are sort of delaying when they charge these increased prices, so really buttering out the impact of tariffs. And other countries really haven't retaliated against this as much as people thought. Now, Bostic also said that it's also taking longer to fill vacant jobs. And so in some markets right now, there's actually a shortage of workers, which potentially means you end up getting worker pricing power and wage price inflation, leading him to say, hey, maybe we got to be cautious here. Now, keep in mind, there's really no evidence of wage price inflation right now, but it's an argument. It's an argument that, hey, maybe there are parts of the economy that are still suffering worker shortages, and that could lead to inflationary pressures. All right. So Bostic basically says we need more weakening before we could really commit to more rate cuts. Muslim, who also spoke this morning, roughly says the same thing. He actually says that financial conditions are so loose right now that we really should be cautious on cutting. I mean, I think Zero Hedge had a fantastic piece from where they basically broke down Hartnett's like almost S&P 10,000 price target for September of 2027. And basically, Hartnett is arguing that we are in a bubble, but that bubble is going up between now and September 2027. That basically we are in a relentless melt-up. Gold at highs, credit cards at highs, stock market at highs. And basically, the way to look at it is while you have all of these things at highs, credit cards, stocks, gold, we're getting rate cuts, we're getting tax cuts, and, tariffs are not meaningfully showing up yet. On top of that, you've got the biggest jump in U.S. mortgage refinancing since March of 2020 on lower rates as the Fed is cutting into an accelerating market. This, by the way, is great for the stock market. I mean, look at Apple today. Apple's just absolutely killing it today. Tesla, absolutely killing it today. And I personally am bullish a slow slog continuing on the Qs. We had a meet Kevin Alpha target of 600 on the Qs, and we hit 600 last week. We hit 600 again this morning because we were at 599 when we opened this morning. And I think this continues in the face of this sort of like expanding bubble, if you will, which is fine. You can make money off of it. But also refinancing activity. Consider this for a moment. Refinancing activity and the real estate market. Where is that money coming from, right? A lot of people are like, hey, like, how do people have money to refinance right now? How do people even have equity is the idea, right? Well, here's the answer for you. 54% of homes in the United States are owned by seniors. And the vast majority of these seniors, 76% of them, have no mortgage at all. I'm a real estate guy, okay? I look at real estate data very closely. And these seniors are refinancing and pulling money out of their homes. Their loan to value right now on average is only 24%, which means they barely have debt on their homes. Some of that money is literally going into consumer spending, financing their lifestyles, vacations, buying junk for, their kids or grandkids or whatever. Some of the money is actually also going into the stock market. And you have to think about it this way. Why borrow on margin when you could get margin called if you could just take out a home equity line of credit at 8%, which is way cheaper than a personal loan from SoFi at, say, 12 or 13%, way cheaper than a credit card at 20%, and no margin call. Just take some money out of your real estate and go throw it into the stock market. All of that absolutely contributes to a disaster in terms of a bubble economics, right? That's not good in the long term. But in the short term, it's fantastic, because in the short term, it just means you have this available capital that people can reap or extract from their real estate and keep this economy booming. And seniors are heavily in part to blame for this. Now, HELOC lending, and this is a very interesting one. And then today, real estate related names are doing, they're not doing as well because those yields are coming up. We knew that, right? Even before the Fed meeting, I said, hey, look, course members, if you are investing in real estate related names, expect some air to come out of the balloon after the Fed, because they're gonna end up seeing, as if they're anything but super dovish, like if we get a neutral Fed, we are going to see yields go up and it's going to hurt the real estate names. So just know that. And that's exactly what happened. But there is a company that, as course members, we bought on IPO day. And that company has been straight up since then. On IPO day, we were around $34. It's trading for like $43 right now. So this company is a HELOC provider. And what's really interesting about those home equity lines of credit is that home equity lines of credit have more than 5x'd from 2009 to today. So that home equity industry is skyrocketing. On top of that, second home loans are also blowing up. Rocket Mortgage is the third largest provider of second home loans. So these lending plays are really helping enable this sort of like stock bubble that we're seeing. And as rates slowly trend down again, which they'll normalize back down again, these companies could continue to be big beneficiaries of people basically breaking the piggy bank of their homes and investing in the stock market. And again, if you want all those sort of like buy, sell alerts, everything, make sure to get the Meet Kevin membership at meetkevin.com. But you already know that. Let's keep that discussion short. So that said, now we've got to consider Muslim also goes on then to tell us, hey, look, the jobs market right now, we really need to see a real plummet in jobs to actually encourage some form of continued rate cutting cycle here. And so what do they say? They say that, well, markets say that current ADP jobs expectations for next week, 50,000 jobs. That would essentially be unchanged from the prior 54,000 jobs, which would not be conducive to rate cuts. The BLS current estimate, 42,000 jobs. Now, we only have a few estimates right now. That'll change, but that's way up from the 22,000 that we had prior. Remember, 22K prior, really low. That's like indistinguishable from zero once you factor in revisions. It's actually probably negative. So going back from 22K to 42 would be good. Maybe gets us out of that negative territory. In addition to this, both Muslim and Bostic saying we really need to watch that data as it comes out next week, because unless we get really weak data, we might be done cutting, which is unfortunate, but that's okay. So they say more cuts are conditioned upon further job weakness. Policy uncertainty easing could also add to growth. So businesses potentially, this is like a double negative, are getting less uncertain because like we get tax cuts, we kind of understand the tariff dynamic and stuff now, which leaves us, quote, little further room for rate cuts. So both of these folks, unfortunately, talking down the idea of rate cuts. Muslim also goes as far as saying that labor market risks, while they're weighted to the downside, we have not actually seen the benefits of AI productivity yet. Says it's too soon to argue we've seen the benefits of labor market productivity, which could contribute to a boom. So you've got Bostic saying, hey, maybe we've got still shortages of employees, which could lead to wage pricing power. You've got Muslims saying, hey, AI productivity and business uncertainty, both of these things are tailwinds for the economy. We got a lot of things suggesting that this economy could truly soft land. And unless we get bad reports here over the next, couple weeks over here, don't expect big rate cuts. Maybe one and done is the way to go. Right now, markets are pricing in about a 90% chance, 90.9% chance of a rate cut October 29th. And then we have about an 82% chance of a second cut thereafter, which leads to a combined set of 1.7 cuts priced in for the rest of the year. So even in the face of that jobs weakness that we had last month, unless we get even more weakness, we're just not seeing the pressure for more rate cuts. Cody here says, won't Doge make the next two reports very negative? This is a reference to I've been asked about this like 20 times. Sorry, I've been asked about this so much, so I got this answer ready to go. Live stream comment here. Thank you, by the way, for the $4.99, and thank you to somebody else donated to post a picture here, like an emoji picture, donated $19. That's really nice of you. Double prizes. I appreciate that with the little trophy you're holding on. Thank you. So here's the thing. Yes. Doge rate cut or job cuts that took place at the beginning of the year, those positions see their leave end in September. Those people could immediately apply for unemployment, which those numbers would show up the first week of October. So yes, that could be really bad. In addition, you are going to see some people take longer to apply for unemployment. So not all of the numbers will show up all in October. They could show up in November. However, what markets are going to do is markets are going to look at those labor reports and they're going to say, okay, let's say we got a bad jobs report. How many of those bad job numbers were Doge related? And they will add those back in. So in other words, let's say we get 50,000 jobs, but then we're minus 100,000 because of Doge. I think markets are just going to go just add the Doge numbers back in because they're one time. Oh, cool. Okay, we're growing at 50,000 jobs. And it'll actually be bullish the economy rather than bearish the economy. So whatever ends up happening with this September jobs report is critical. But whatever happens because of the Doge portion is not critical. The Doge portion will get adjusted out. It's everything without Doge included that will matter. So that's really important. So I would watch that very closely. So let's see. Do you think H-1B new fee will push companies to hire more remote workers? Yeah, that's what I was talking about earlier. Is that you're just going to hire people, and then park them somewhere else. They don't necessarily have to be remote. They could be remote, but you can also hire people and then park them in Canada or in Mexico or wherever else because there's no tariff on labor, right? So think about that. There's no tariff on labor. So, somebody in customer service working out of Vancouver to provide customer service to America, hey, there's no tariff on that. So if there's no tariff on that, you may as well not bring H-1B people into the United States. You may as well leave them somewhere else. The long-term downside of that is you have fewer people in America. But that's kind of what Trump and Lutnick want. They want fewer people in America because they have this argument of nationalism, which is, hey, these people are coming, taking our jobs. Whether that's true or not, I guess remains to be seen, but it's worth considering. That's the environment that we're in right now. So, yes, as usual, we have a government shutdown looming October 1st. Who cares? Nobody usually cares about that. And then we have big job data on the 1st with the ADP and on the 3rd for the BLS survey. But until then, you've got a Fed here that's like, hey, things are booming. Who cares right now? Why are we gonna promise all these extra rate cuts when the Atlanta Fed GDP is sitting at 3.3%? I mean, look at this. And the next GDP update we'll get is on Friday. but it's pretty impressive. Now, there is talk that, certain segments of the economy are potentially in recession. There was a comment that the Financial Times apparently made that you've got maybe construction in a recession. I actually think that's great. It gets, a cheaper opportunity to pick up, construction related material for house hack. I'm a big fan of that. I love that because, we're building ADUs, like we're building more homes, but that's what we do, right? Like we're a company, we don't just buy fixer-uppers and provide housing, but we also build housing to provide more housing for people. And then we're booming on our AI. Like we don't want the market to crash. Look, if we go into a recession, it'd be great for interest rates. Interest rates going to zero, fine. We'll break the piggy bank, so to speak. We'll refinance our properties that have no bank debt. So I guess it would be finance, not refinance. And we'll go buy a bunch more homes and do the same thing, build more housing, which is what people want. But as long as the economy keeps booming, like we'd rather sell our AI product because it's, we think, going to be mega profitable. I mean, no guarantees. I'm a little biased in CEO, but I think what we have cooking with our AI is so good and so powerful that it's unheard of in the real estate industry. And I think it could 1,000x the valuation of house hack. Again, I'm mega bullish on it, but we'll see. So in a good economy is a great time to sell an AI product. You don't want to sell an AI product in a recession. I'm just saying, it's hey, either way we go, it's fine. So I don't have a bias. Oh, look, a banner. Get $30 off on the Meta glasses. They just came out with new Meta glasses too that have more battery life. So yeah, you could use meetkevin.com/meta to get that. Meetkevin.com/Webull also. I'm pretty sure Webull's still doing their 2% balance transfer. So if you get 2%, if you balance transfer your funds into Webull, that's where we always watch the lines and target our $600 target here. We'll hopefully go up from here. And then if you're looking for a good fintech bank, go check out meetkevin.com/bank. All paid sponsors there. But anyway, let's see. Somebody here says, all the contractors I know are still booked out 3 months, which is pretty healthy. Well, that's great. Every area is going to be different. And remember, as a licensed contractor, you have to book out. If you don't book out, you're going to start taking jobs you shouldn't be taking. So you have to book out, especially since you have to consider permitting projects for a lot of contractor work. So I don't know that, the anecdote that, hey, contractors are still booked out 3 months is super useful, just because there is a risk that is just very typical and normal. So anyway, somebody here says Beechcraft Aviation Museum in Tennessee is a must visit for aviation lovers. You donated $9 to say that. Well, that's very nice. That's very nice to you. I'll have to check it out. So anyway, 50 states, 50 highest points. Okay, let's go. Yeah, hit them all before you turn 50. All right, so that gives us a little bit of economic insight.
Knows about this.
We'll try a little advertising and see how it goes.
Congratulations, man. You have done so much. People love you. People look up to you.
Kevin Paffrath there, financial analyst and YouTuber. Meet Kevin. Always great to get your take.